Let's understand the themes of the markets that are playing right now. And for this, let's get the discussion forward with our very special guest on the show, that is Mr. Siddharth Vora, Head of Quant Investment Strategy and Fund Manager at PL Asset Management. Hi Siddharth, this is Shrishti on the other side, and thank you so much for your time to ET now. First up, wanted to have your take on the movement on the benchmark indices. Where do you see that the opportunity still lies? Because we are indeed in a furious bull run.
So, right, I mean, the data does suggest that we continue to be in a bull run. But as per our quant models, what the latest signals that we've been capturing over, say, the last 10, 15 days is that firstly, the valuations have already been uncomfortable for mid and small caps, and they continue to be in the uncomfortable territory. The large caps still provide a much greater margin of safety. And even if you look at how the large, mid, and small market cap as a percentage of total market cap over, say, the last 10, 20 years, it's very, very evident that large cap is trading at its lowest sort of. Our models are suggesting us that there could be a shift in regime and a shift in market regime from a value and momentum oriented regime to a probably going into a quality and low vol oriented regime. So what we've done over the recent times is built a tactical defense layer by adding healthcare and consumer oriented stocks in our portfolio, also now comprising of roughly 1/3 of our portfolio. So these have been some changes that we're making in the portfolio, and we still are positive on the markets, but at the same time we want to balance risk and returns as opposed to just focusing on returns that we did for the last, say, 12 months or so.
That's the kind of a view that you are having, that even the healthcare and some of the consumer stocks are expected to do well. But at this point, just wanted to understand what kind of a time breadth or time horizon that you are looking for these stocks to outperform. Because given in this kind of a market, though these counters have been a bit underperformer, but it's the consensus voice, and specifically on the consumer pack, that is now getting back into the markets. So any time horizon that you wish that for this long these plays can do well in the markets?
So the way we construct our portfolio, we review and rebalance the portfolio on every 2 month basis. So it's a bi-monthly rebalance cycle that we follow in AQUA, which is a quant PMS. And while we continue to maintain our significant overweight on all the pro-cyclical sectors like industrials, infrastructure, cap goods, automobiles, real estate, we continue to be overweight on this. We've just now started gradually building a tactical layer. So the idea is that for the next 2 months, we believe that there could be some shift in the market regime. And while we are going through this shift, we should have some sort of a defense layer in our portfolio. Even if that doesn't really, play out the way our models are visualizing it, it would still help reduce the portfolio beta. Because our broad theme right now is that we were in risk on mode till, say, January. From last year till Jan 2024, we were in a risk on mode. And now we've been in a risk transition zone, which means you're still bullish, but you should probably reduce the risk that you're taking at a portfolio level. So the idea is to create a tactical layer of defense for the next 2 months or so.
The defenses, Siddharth, what I could see in your AQUA portfolio is that stocks like Cochin Shipyard and some of the railway counters that have done phenomenally well for you, as well as a lot of our viewers as well, I believe. And these have been the flavor of the markets for quite some time now. But at this point, do you believe that there's still more headroom and you'd continue to be constructive at these plays?
So the idea that we always follow is whenever we have, massive winners like we've had, say, in the last 12 months, whether it's, say, BSE, Cochin Shipyard, PFC, REC, HDFC, AMC, Nippon, like every stock, Mazgaon Dock, for example, these have been some of our very large winners where we've made multi-bagger returns. What we do is every 2 months, we bring their weight down. So we trim and book their extra profit and go back into our original equal weighted portfolio construct. So AQUA operates a 25 to 30 stock portfolio, but which is equal weighted. So the equal weighted strategy helps us not only divide the risks, but also ensure that our returns are very, very granular and well spread across majority of the portfolio rather than generating concentrated returns from one or two stocks. That's not something we believe is repeatable in future. So we believe very, very firmly that the equal weighted strategy with granular returns is the way to go when you're managing a quant portfolio strategy. So we have been, booking partial profits, trimming, and pruning our positions back to more acceptable levels.
All right, and a couple of more questions, Siddharth. Since you did highlight some of the sectors that you like at this point in time, do you believe that some of the sectors are over-owned at this point in time? Any place that you wish to highlight?
So I think broadly every sector where there is consensus on growth, consensus on policy continuity, a regular flow of good news, coming in terms of order books or inventory levels or execution. I think there is a lot of consensus built around the fact that yes, there is extremely strong visibility in these sectors, and therefore everyone from institutional investors to retail investors to HNIs continue to like them and continue to own them. So whether we talk about, say, the defense space, the automobile space, the cap goods space, the infrastructure and PSU space, all the cyclicals is where the consensus on growth is. And because growth is higher, because growth is more visible, of course, the valuation multiples appear to be slightly stretched. But I think if you look at a 3 or 2 year forward peg basis, you will be able to still own them in your portfolio.
Given the kind of a move that we are seeing in the financials as well, Siddharth, what I could see is that it's almost 12% of your exposure in the financial space. Do you believe that that going ahead, there could be some churning or change in your contribution or your weightage to the financial sector right now?
So the thing is, we tell this to all our investors, right? That when we are managing a quant strategy, we are not trying to predict the future. Neither are we trying to take allocations on sectors or stocks based on any predictions we make. We strictly follow a data-driven approach where our models take all the decisions and we are simply responding to the changes in market data. So usually the approach we follow is the approach of sector rotation. So as time passes, as more data comes in, we relook at all the different indicators that we look at, from valuation to volatility to growth to earnings expectations to breadth for each of the sectors, and then redecide if we want to change our sectoral exposure. As of now, I think the portfolio you are flashing it's an older portfolio. I think it's 1 month outdated, and in the newer portfolio, the concentration of financials has actually come off a bit rather than increase. So we have still not, aggressively participated in the private banks. So for the last year, we've stayed out of private banks and we continue to still stay out of private banks.
Thank you so much, Siddharth, for sharing your view on the financial space. A lot of these experts have been sounding very bullish. So just wanted to understand your view on the same sector. But thank you so much for highlighting rest of the sectors that you're bullish on and how do you see the markets placed right now. Great chatting with you. But with this, viewers, let's move on.